actually, we were looking at buying opportunities for S&L. So we were seeing growing portfolios of REO or real, properties that have been foreclosed. And so we were eyeing those for acquisition opportunities. The biggest lesson learned, and it was a carryover from my days working in New York at the bank, is conservative deal capitalization in the long run works best. And that's a lesson that Jim and I have taken to Paladin over the last 30 years. We always start, whenever we are looking at a new deal, we don't look at, I don't want to hear about what the debt structure is. I want to know what is the asset currently generating, unleveraged, and where are we going to take it, and how much is it going to take to get there. So it has to be a deal that pencils attractively on an unleveraged basis. We always do that. And then we decide what is the appropriate amount of debt financing to put on it, always with an eye that in all likelihood, that investment's going to go through some market disruption. There's going to be some event unforeseen, whether it's a recession or an earthquake or something, that we don't want to be over leveraged, because that all it does. I mean, in good times, it's great. Leverage amplifies good news and bad news quite significantly. And we'd much rather. We've always described that our business at Paladin's a little boring because we're not swinging for the fences looking for home runs. We're really trying to hit steady single and doubles on everything that we do. But we want strategies where, when the market does turn in an unforeseen manner, our capital is preserved. Preservation of invested equity is probably the single most important consideration that's on our mind. And that wasn't on anybody's mind back in the late 80s and even in the early 1990s. Wasn't on anybody's mind. Nor was it on anybody's mind in the early 2000s.